Hello, everyone. Welcome and thank you for joining me for this Entrepreneurial Toxic Relief Guide webinar, which is a backed by popular demand segment that I decided to bring back based on the feedback that I received previously. So the title of the webinar is intentional, because what happens is oftentimes entrepreneurs face toxic measures in business that hinders them from success and from growth. And this often leads back to tax. So the idea here is to create a guide that can relieve taxpayers or entrepreneurs from this toxic measure that exists in business. With that being said, let's make sure we move. There we go. My name is Rose Brown, also known as the Accountant Therapist, and I am the CEO of Brown's Fulfillment Consulting and Accounting Firm. I am an entrepreneur, but I'm also an accountant and educator at heart. My deepest desire is to educate and bring awareness to entrepreneurs that they're able to use this information to make better decisions in their business. I specialize in taxation, bookkeeping, payroll, and business formation. What I do is I use these 4 elements to assess a client in a holistic manner, which means I look at all 4 of these elements to ensure that their foundation in business is solid to where that they don't have to look over their shoulders wondering if the IRS is going to come, if they're missing something within their foundation. If you want to learn a little bit more about what we do, you can visit our website at www.brownsfca.com, or you can shoot us an email at info@brownsfca.com, or give us a phone call, 215-717-8293. So here's the thing, as we move forward in the webinar, I'm sure there's going to be questions. So ensure that you drop all your questions in the chat box, and I'll try to get to all of them as time permits. However, I do understand that tax and accounting is an intimate aspect of business. Therefore, if you don't feel like dropping that question in the chat box, but you want to speak with me one-on-one, please be my guest. Just reach out to me in whichever way really that's comfortable for you. We are on social media platform, LinkedIn, Facebook, and Instagram at Browns_FCA, or you can follow me at The Accountant Therapist on all of these platforms, Instagram, Facebook, and LinkedIn. So let's jump right into it. So upon the conclusion of this webinar, you will be able to estimate your self-employment tax liability, understand what it means to pay yourself as a self-employed individual, know when and how to make estimated tax payments, understand why tax planning is an essential part of being a self-employed individual, understand how bookkeeping should be maintained, be able to determine what is considered a deductible business expense, and understand how the home office deduction works and how it may apply to you. Because let's face it, this pandemic has caused a lot of individuals to start their own home-based businesses, and there's a lot of hidden deduction there. So we have to take advantage of those as entrepreneurs. So at the base of any business is its identity. And that means similar to us as individuals, we need our identity to know who we are. We don't want to be lost, because without the identity, you're lost. And it's the same idea for a business. You want to ensure that a business has its own identity, an identity that is separate from you as the individual. Now, the first step in securing a solid identity in business is assessing and finding the right business tax entity for your operation. Now, that could be a sole proprietor, an LLC, a partnership, a corporation, whether that's a C Corp or an S Corp. Nevertheless, you should use tax savings and asset protection as the driver to determine which one you ought to go with. Nevertheless, when you decide on a business tax entity, you should decide not based on today or tomorrow, but for the future ahead. For example, how would you like to pay yourself? Will you have employees? Are you looking to offer benefits, not just for yourself, but for persons that you may employ within your business? So at the base of that, you have to ensure that you choose the right business entity, because moving forward in business, most things that happen for tax and accounting purposes will impact you based on your tax entity. So once you get to a comfortable place where you've now chosen the entity that you believe is best for you, you want to obtain an employer identification number. Now, the employer identification number, which is the EIN, cannot be obtained until you have chosen a business entity. Now, think of the EIN as the social security number of your business. Many organizations and agencies won't even work with you without you having this EIN. And you want to keep your business separate from your personal, meaning you don't want your social security number being used for the business. You want to let the business have its own identity. So once those two things are secure, you want to register with your state. And that simply means you are incorporating with the state, communicating with them, letting them know that, hey, I am operating in your state as this particular entity under this business name, and these are the activities that will be conducted. Now, you must know that if you decide to move the business to another state, you have to reincorporate your business, whether that's if you're incorporating it from scratch, or you decide to keep the business as is, but incorporate it as a foreign entity. So you do have options there, but you still have to remember that every time you move the business in a different state, you have to incorporate there. Now, once you've secured your state-wide compliance, you have to move to your city compliance. Now, depending on the city you're operating in, each jurisdiction requires different requirements. And an indicator that, let's say, a requirement is needed is dependent on the city. So that could be New York City, Boston, Washington, D.C., or here in Philadelphia. So let's use Philadelphia, for example. In Philadelphia, to operate, you need a commercial activity license. Now, that's across the platform, whether or not you are for-profit or nonprofit, you need a commercial activity license. And even if you are operating in a specialty industry or just a certain type of industry, for example, say you need a liquor license, before you are able to obtain that liquor license, you need to obtain a commercial activity license. So that's a basic requirement for any business operating in Philadelphia. And in addition to a license, you also need tax accounts. Now, there are two important tax accounts in Philadelphia that are needed by business owners. Now, depending on your business entity, the type that you obtain will vary. And that's why your business entity is so crucial. And you'll hear me go back to your business entity time and time again, just to really pronounce the importance that's there. So if you were, for example, an LLC operating in Philadelphia, you would need what is called a BIRT, which is a business income receipt tax, and an NPT tax account, which is the net profit tax. Whereas if you're a corporation, all you need is a BIRT, and not getting the NPT limits your tax obligation. So that's a good thing there. And while you're obtaining all these legal filings, you want to ensure that you have an operating agreement in place. The operating agreement is especially essential when you are going into business with someone else. You want to ensure that literally all cards are on the table. Everyone understands who's responsible for what, and what their duties are, as well as their ownership. So the operating agreement is basically the outline of the internal structure of the business, meaning it tells you what the name of the business is, where it's located, who owns what percentage, what happens when the business is dissolved. While that's done, you want to ensure that you obtain a separate business bank account. Now, a business bank account helps you in so many different ways. It increases your potential to maximize tax deductions. It helps you to avoid the potential of commingling, and also it helps with bookkeeping, because if you have one business bank account that all your business transactions flow through, you know for sure that when tax time come around, you don't have to worry about dissecting a business transaction to whether that's personal or business, because at the end of the day, if you cannot decide or show proof that a particular transaction is personal or business, you can't claim it. And key thing to note here, if you do not have an operating agreement, you cannot open a business bank account. However, if you do go to the bank, they'll have you sign their generic internal form to sign off as an operating agreement. That's why the operating agreement is so important for legal purposes. And lastly, you want to ensure that you obtain a DUNS number. So as individuals, we have our social security number where our credit is reported against, and that's what the DUNS number represent. The DUNS number help you to create history in your business so that you have favorable advantages for capital if ever need be, or really for cash flow purposes as well, because the DUNS number help investors and lenders see that you have a history of financial stability, and they can use your track record to determine whether or not they want to lend you. And as it pertains to cash flow, you're able to obtain either a net 30, a net 90, or a net 60 account. And in that perspective, you have 30 days or 60 days or 90 days to pay off, say, a debt with these particular vendor. That way you can use the time to facilitate and you put an efficient system in place to manage your cash flow in your business. And that brings us to self-employment taxes. So this is one of those things that often creeps up on business owners because they simply don't understand what self-employment taxes are. And even if they saw it on a tax return, they simply still don't even know what that is. So to break that down, self-employment taxes are assessed to individuals who are self-employed. And those are your sole proprietors, your single member LLC, your multi-member LLC, and your partnerships. However, this does not include your S corporation and your C corporations. So to break this down a little further, let's compare W-2 employees with independent contractors. So as a W-2 employee, your employer is responsible for all things taxes. What that means is you fill out a form and you give that to them. Now they calculate or put it in a system and it calculates how much taxes will be withheld and what will be paid. Now they're responsible for all of that. They withhold it from your paycheck and they pay it to each of the tax agency. Whereas if you're an independent contractor, you're responsible for all things taxes. Now you have to think about, well, how much do I withhold? How much do I pay? And that's where self-employment taxes come into play. Because if you don't pay throughout the year, you'll be assessed this self-employment tax. Now, self-employment taxes are assessed based on the net profit of the business. And when you think about net profit, that's the income minus the expenses. So whatever your bottom line is, that becomes your net profit. Now that net profit is then used to calculate your self-employment taxes, but the calculation is based on a 15.3%, which is standard from the IRS. So 15.3% of your net profit becomes your self-employment tax. And that self-employment tax is paid into Social Security and Medicare. So let's think about an employee again. So an employee pays half of Social Security and Medicare, while the employer pays the other half to bring the amount up to 15.3%. Now, as a self-employed individual, you are both the employer and the employee. Therefore, you have to pay the entire 15.3%. The good news about the self-employment tax is that 50% of that is deductible, but that's deductible before your taxable income is configured. However, the full amount will be due unless you have estimated taxes that were paid, or if you had credits that can offset that self-employment tax. So, for example, if your self-employment taxes were $4,000, of course, $2,000 of that, which is 50% of the $4,000, will be deductible. However, that full $4,000 will be due as a tax liability unless you made estimated tax payments or you had some credits. For example, you went to school, you had the education credit, or you had a child tax credit. The question then becomes, after all of this, well, Rose, what does that mean for paying myself? And the way you pay yourself depends on your business entity. And you see why choosing the right business entity is so critical to the operation of your business. So when you're a sole proprietor or a single member LLC, you pay yourself by taking owner's draw from the business. When you're a multi-member LLC or a partnership, you take what is called guaranteed payments. So those draws and payments that you take from the business is not deductible for the business, but it's taxable to you. Whereas if you were an S corporation that is active within the business, you would be on payroll and you could receive shareholder distribution. And as for the C corporation, you could be on payroll again if you're active in the business, and you can receive dividends as well. And that's where the difference comes. Well, how do you want to pay yourself? Which entity fits how you foresee paying yourself would be beneficial? So if you take draws or guaranteed payments, that is not deductible to the business, only taxable to you. And that brings us to estimated tax payments. And estimated tax payments are usually paid throughout the year, say monthly, quarterly, annually, or even customary, depending on how your current tax situation is. And this is often required for taxpayers or business owners who owe over a certain amount. And that's required by the federal, state, and local tax agencies. And this can be calculated based on either the prior year tax liability or the current year's profit. Now, we have to be careful there, and that's why I said even customary. That way you can customize the payments that you make. Because in a year like now, 2020 has been a very eventful year that has impacted many businesses. Whereas last year, the business may have been booming to where, you really needed to make estimated tax payments. But this year, your revenue have decreased somehow, and your expenses may have stayed stagnant. You may not have the requirement to pay estimated tax payment because your bottom line have been impacted, or you may not need to pay as much. Now, estimated tax payments can be paid either via check or electronically. And for the IRS, electronically, that could mean you pay through EFTPS.gov, or you go through irs.gov/payments. Or if you choose to mail in a check, you can do so with Form 1040-ES accompanying it. While for the state and the local agencies, they still have similar ways that you can pay, but you have to go through their system. So they have an electronic method, and they also have a mail-in method. And as for tax planning, so tax planning is critical whether you are an individual, you own a business, you have rental properties, whatever it is that you do, you have to do tax planning. And tax planning is essential because the way you plan could be the difference between you legally avoiding taxes or you illegally avoiding taxes, which is evading taxes. So let's break that down a little bit. So when you plan to avoid taxes legally, that means you are strategically putting a plan in place to reduce your tax liability or avoid paying taxes altogether. And again, that's on a legal spectrum, where when you evade taxes, that means you're intentionally avoiding to pay taxes. And yes, that's illegal. And the way you can think about that is if you underestimate income or overstate expenses, you are in fact evading taxes. So that's why everything that is in this webinar is critical to the way you operate your business so that you can avoid, again, taxable mistakes. And when you think about tax planning, you have to incorporate the previous slides because your business entity determines how you will be taxed, when you will be taxed, and the percentage depending on that entity. Now, depending on the entity, you may be assessed self-employment taxes. Now, if you're assessed self-employment taxes, we have to figure out, well, what can we do to reduce that? Or if we can't, well, how much estimated tax payments do we need to make throughout the year? Once you have that all in mind, you should actually be meeting with a tax advisor like myself at least once per quarter. That way you have all your ducks in a row, and we're constantly assessing your tax situation. And for individuals who are Uber drivers, Lyft drivers, freelancers, they're self-employed in some way and they're receiving upfront funds without any taxes withheld, there's a common rule of thumb for tax withholding, and this is important for tax planning as well. So the rule of thumb is 70 to 30. And what that means is 70% comes home with you and 30% gets paid into taxes. And that 30% on average covers federal, state, and local. So if we take a look at the example on your screen, say on a 2 weeks basis, you made $4,000. 70% of that comes home with you, which is the $2,800, and you withhold 30%, which is $1,200. Now, if we assess that on an annual basis, you have $52,000 cumulative income, $36,400 being taken home, $15,600 withholding for taxes. Now, when we sit down to tax plan together, you may not necessarily have to pay that $15,600 in taxes, because we take into consideration your filing status. Are you married? Are you single? Are you head of household? Do you have a dependent? Have you been in school? Are you working from home where you're able to take advantage of the home office deduction? Or if you're driving Lyft or Uber, what are the mileage that you've incurred upon your vehicle that we can deduct? And other expenses that sometimes the average taxpayer may not even know that they can take advantage of, but sitting down with myself, you're able to see, well, oh, that's a possibility. Maybe we can go that route and reduce my tax liability or the taxes that I would have ordinarily had to pay. And that brings us into bookkeeping, because bookkeeping pours into tax planning. And in order to have a sufficient bookkeeping, you need to have a record keeping system in place. And that could be Excel, where you do it yourself. You just sit there and manually enter your transactions on your own. A step up, you can obtain a software, whether that's a free software or a paid software. Though you're doing it yourself, it's more automated, where the transactions are flowing into the software and all you need to do is monitor it, maintain it, and etc. The next level up is hiring a bookkeeper like myself. And hiring a bookkeeper allows you to not do anything bookkeeping related. That bookkeeper would maintain all your transactions that come into business, maintain everything to where all pennies, down to the pennies, accounted for, your books are reconciled, and you have accurate information to produce your financial records. And obtaining a software and a bookkeeper is beneficial in so many regards, because it helps you to save time. It can be a small investment, and it may be one of the best decisions that you make in your business, because the time that you sit and take to focus on bookkeeping could be the time that you take to refocus on something else within your business that can really increase your bottom line. And lastly, business owners often neglect or overlook bookkeeping, and they don't see the importance of it at the beginning. But as time go by, especially for tax time, they see that, well, actually bookkeeping is extremely important, because it helps you to maximize your tax deductions and also helps you to make decisions in your business, because you're then able to pull from accurate data. So having that information helps you to say, well, maybe I need to stop spending here or increase sales there. So there's a couple of things that you can do when you have accurate financial information to pull data from. And that brings us right into business expenses. Now, with your business, you have to be careful what you claim as an expense and what actually is in reality an expense. So before you're able to do anything expense related, you have to first understand what is a business expense that is tax deductible. And in order for a business expense to be tax deductible, it has to be ordinary, necessary, and for the purpose of the business. And when I say ordinary, I mean, well, is it a typical expense for your industry, for your position, for your title, is will it be compatible to someone else in your industry, in your position? And then necessary, is it a necessary transaction in order for your business to grow, for your bottom line to increase? And in order for a transaction to be necessary, it first has to be ordinary. And lastly, the purpose of the business. That transaction needs to support the purpose of the business. It needs in some way to have a reason to why it's taking place. No transaction should ever just happen just to happen. You should always have a reason for that expense. And with that in mind, you can use this 3-step technique system to help you to plan, track, and trace. And when you keep these 3 terms in mind, it helps you to approach business expense in a different light, to be able to plan the actual expense, track the actual activities that you've planned, and then trace it. Can you show me proof? So if we take real estate, for example, real estate investors, when they go out to obtain a property, they go out to obtain a property in an effort to increase their portfolio, as well as take a large deduction in the first year or over the life of the property. So that's referred to as depreciation. So you can either take it in the first year or over the life of the property. So they've planned this transaction, they've planned this expense, and any expense should be planned, especially if they're large or major within your business. Then you track it. So as a real estate investor, they'll be tracking the activities leading up to the purchase, the actual purchase, and after, which would include your utilities, your mortgage payment, and all those other criteria. Then you want to trace it, and that simply means, well, can you show me proof of this particular transaction? Because if you're not able to show me, the accountant, proof, or an auditor, it simply did not happen. So think about it like this. If it's not traceable, it's not deductible. And a couple of examples to think about as it pertains to business expense could be your office expense, meals, travel, rent, salaries, and wages. However, you must note that this does not include owner's draw. So owner's draw and guaranteed payment is not deductible to the business. It's a business expense, but it's not tax deductible. Therefore, it's taxable to you. So in the arena of business expense, you've probably heard that any business expense can be written off, and that's true, but it all comes down to the facts and the situation. So you change the facts, you change the situation, and let's look at 2 prime examples for this. So let's say you enjoy going on vacation and your preferred place is Miami. You plan to obtain a property in Miami. That way you can do business activities around that and enjoy your vacation. So what that looks like is you plan to meet your property management company, your investors, or your tenants, or you're going down there to monitor the maintenance of the property. You plan to go on your vacation. You ensure that you track this by using either the business credit or debit card, and then, or if you use your own personal funds, how will you be reimbursing yourself? So now if you go down to Miami and you're on vacation, at least 4 hours out of the 8-hour business day must be dedicated to the purpose of the business. And that's where it comes into play. That's the only stipulation. You need to be 4 hours dedicated to your business expenses. After that, hey, you can go around and walk on the beach, enjoy yourself. But you have to have planned that transaction. You want to track it, like I said, using a card. That way you have proof, and then tracing it. Can you show me the proof of this particular transaction? Because if you use your bank card, of course, you have the bank statement, which is phenomenal. But if you are reimbursing yourself or you use cash, you have to retain proof of those purchases that you've made while you were down there. And the second example to think about, it's a simple one, but it's one that we often don't think about because it's just not on our radar. So meals. So oftentimes we go out with our loved ones, we go out with our friends, and we sit and we actually talk about business and not writing it off as a tax deduction And in that moment, you're robbing yourself of tax savings. So when you go out to eat, the conversation, of course, needs to have some type of business related to it. And it's business relating to how can you improve your bottom line? How can you improve your internal control? Whatever it may be, but it has to be for the improvement of your business. And of course, you're going to have personal conversation, that's fine, but you need to have that business conversation. And you write it off, you track it. And again, you can use that business card, credit card or debit card, or you can use your personal, and that way you reimburse yourself. However, keep in mind, whenever you reimburse yourself, you have to keep great records of you doing that and proof of that actual transaction. Because again, remember, if it's not traceable, it's not deductible. And that brings us to the home office deduction. Now, a lot of business owners do not claim the home office deduction because of two reasons. The first is because they're often unaware of the possibility that it exists. And the second is the myth of an audit. And the reality is anyone can be audited, whether you've prepared perfect returns or have spectacular bookkeeping records, you can be audited. At the end of the day, you still need to be able to prove all the claims that have been made. So as long as you can prove it, it's fine. You have nothing to worry about because you've done everything correctly. All they're asking for is proof. Now, in order for you to actually claim the home office deduction, you have to use the space within your home exclusively and regularly for business. Well, this means that that space cannot be the playroom, it cannot be the hangout room. It needs to be exclusively used for business. And as it pertains to regularly, that means this is where you regularly conduct business. This is where you meet your clients. And that doesn't mean you can't have a PO box or say a commercial address where you get mail in. Not at all. You can still have that, but this space needs to be regularly used for business and exclusively. With that said, there are two methods used to calculate the home office deduction. And these are your simplified method and your regular method. Now, the simplified method was created a couple of years ago to provide business owners a more simplified way of calculating the home office deduction. However, this method can only be used if the office space used for business is below 300 square feet. And what that calculation looks like is you take the total of the space used for business multiplied by $5. Now, $5 is a flat rate given by the IRS. So if we take, for example, the space that you conduct business in is 200 square feet. You multiply that by $5, you get $1,000 as your home office deduction. Now, if the space that you use for business is above 300, you have to use the regular method. Therefore, your maximum deduction can only be $1,500 because you have 300 times 5 equals that $1,500. Now, as we move on to the regular method, it can be very beneficial as it pertains to the deduction that it gives to the business. However, it requires extensive record keeping and documentation because at the end of the day, whether you choose a simplified method or the regular method, the IRS can come knock on your door and say, hey, I need to come inside and see that space that you use for business, or whichever method you use, they can come and see which one, the space that you use. However, as it pertains to the records, they need copies of those records that you will be claiming as a deduction. And the way the regular method is calculated is you take the office square footage used for business, and then you take the total home square footage. So if we use the same example from the simplified method, you have your 200 as the space you use for business, and then 1,200 as the total home square footage. And if you divide those numbers, you get 17%. Well, that means that 17% of your rent, your mortgage interest, and your utilities will be deductible. So every month, for example, if your rent is $1,200, 17% of that every month or for the time you've been using the office space in the home is deductible. And if it's for the entire year, that's times 12. So 17% of each month's rent times 12%, times 12 to give you your annual deduction for rent or mortgage interest. Now, if you had to do some type of repair and maintenance within that space, and that could mean you needed to paint the walls because now you're doing Zoom conference calls in that space, that is 100% deductible. So anything you do in that space is 100% deductible. However, if it has to do with the entire home, it's only a percentage of that that is deductible for the home office. And the last thing here is documentation. You want to ensure that you document everything that takes place in your business. And that's for the good and the bad, in the sense that you keep track of everything that happens, your business transaction, the agreements that you've signed, everything. That way, if an investor comes and they want to see your records in order to determine whether or not they want to give you a loan, that would be perfect that you have the documentation. And on the other side, if you were ever to get into a dispute, an audit, or something along that line, you have proof of that as well, because documentation tells a story. The documentation that you have in your possession, that you retain, is your weapon in a battle with unfortunately an employee or the IRS or for legal purposes. But you know that no matter what the circumstances, you have these documentation to prove whatever it is that you need to either obtain, whether that's capital or really in a battle. And that's pretty much it for this webinar. I will be jumping over to the chat box to ensure that I respond to all questions within the allotted time that we have. But if, like I said, accounting and tax is an intimate part of business. So if you need to reach out to me directly to schedule a consultation, you can definitely do so through email, through our website, or by contacting me via phone. And again, we are on social media platform, LinkedIn, Facebook, and Instagram at Browns_FCA. And as for myself, at The Accountant Therapist. Now, I know this was a lot of information to take in, and that's why this is a relief guide. However, I have gone a step further to create an ebook, which will be released in about 2 weeks. And this ebook breaks everything down. So what I've talked about today will be broken down in a much deeper manner in this ebook and present more information that you need as an entrepreneur, examples, case study, whatever it may be that could help you in your business is in this ebook. And again, this is for entrepreneurs who have been experiencing, toxic measures in their business, and this will help them to overcome those barriers. So let's jump right over to the chat and see the questions that we have there. So I have, can you give an example of owner's draw and why it's not qualified as a business expense? So owner's draw is when you take funds from the business, and those funds you are taking are tax-free at the moment. And at some point you have to pay taxes on that. And it's a business expense, but it's not deductible for the business. So yes, on say your financial statements, it may appear on there as an expense, a business expense, but it is not deductible because you did not go through payroll. Now, what you've paid yourself through owner's draw is what you pay self-employment taxes on and ordinary income taxes on as well. So that's why owner's draw is not qualified as a deductible business expense. And this is why the entity chosen is so important once again, because if you choose an entity where you go on payroll and you can also obtain, say, shareholder distribution, you get the benefits of both sides of the coin. You go through payroll, and if you need be, you can pull funds from the business as well as shareholder distribution. So I hope that answered your question. And if there are any other questions, I'll just hang around for just a minute to answer those. But again, if you need to reach me personally to have a more intimate conversation about your business, you can certainly reach out to me through any one of those platforms that I enlisted or discussed just now. Okay, so I don't believe there are any more questions. So I will go right ahead and, well, we have another question. So it says, I am a freelancer who is looking for an accountant to assist me in keeping up with my business finances. What are the common costs for accounting services needed only once a year, or do you require a retainer? Now that seems as though it's a conversation that we need to have over the phone. So we will need to set up a consultation, because each client, each individual is unique in their own way. No business is the same. So I have to assess each business based on its activity and what anything else that it has going on alongside the individual themselves. Because if you're a certain type of business entity, that means your income or your net profit flows through to the personal, and we have to look at it in a holistic way. Then I have another question. It says, do you have examples of Excel worksheets that can be used for starting off to track all expenses and income? Yes. So I've created tailored spreadsheet just for this. However, if you're not super familiar with Excel, you may get lost a little bit. But again, this is something that we can connect on, where I can provide you with training for Excel. That way you can understand what's going on the worksheet, how certain cells may be communicating with each other. That way, when you input that information, you're able to make all the decision that's possible for your business. And then another question says, if you have multiple LLCs and a not-for-profit, all being handled out of the same home office, could you be deducting tax from each company or only one? And would this cause for the IRS to want to audit me? So there is a couple of things going on there. With the home office, so you have to be careful there. If it's a not-for-profit, it doesn't count for this. So you won't be able to take the home office deduction for the not-for-profit, because the nonprofit is a community organization. Unless you're actually paying rent, then this doesn't apply to you. As for the LLC, now things get a little bit complicated. You may need to either split the time or claim the deduction all for one LLC, because you don't want to try to overdo it to where you're audited and a negative impact is bestowed upon you. Now, another part here that I want to put out there as it pertains to the home office deduction is, if you incur a loss in your business, the home office deduction will not be a part of your tax return. So if you had a loss in your business, you won't see it as a positive impact for you. Unless you had a net profit, then you will be able to take advantage of the home office deduction. And I hope that answered all